Back to the top story of the day, the Fed raising rates to the highest level since the pandemic. Stocks rallying on this historic move.
Today, the Federal Reserve took aggressive action to tackle the fastest inflation in 4 decades.
It's been an eventful week in the markets, to say the least. We've seen a lot of volatility, liquidation. High inflation rates and interest rates have been all over the place. In today's video, we'll see Raoul Pal's viewpoint on the economy and its future, and we'll also see if the Fed interest rates is something that's really what's driving the market. If you're new to my channel, be sure to subscribe before diving into the video.
From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 percentage point.
Bitcoin price attempted a fresh increase above the $22,000 level after the Fed announcement on Wednesday. But BTC started a fresh decline after that and remains at a risk of a move below $20,000 support. Now, the Fed has not only raised the interest rates by 0.75%, the largest one-time increase in 28 years, but the Fed signaled its intention to raise rates for several months, as they believe that the inflation would remain high for the foreseeable future. Now, Raoul Pal has a bit of a different opinion when it comes to Fed and market. Let's hear him out.
I think there is a narrative that says that the Fed have to do this, but you and I don't borrow at Fed funds rates. The market's already changed our mortgage costs or whatever. So I think the market does its job, but there's some belief that it has to be driven by the Fed and their Fed funds rate. So that is, I think, more of a red herring. I think the free market does its job. However, they have one more other thing in their arsenal, and that is the balance sheet. Printing money or taking money out of the economy. And they have been printing money for a long time to offset the pandemic and the extra borrowing that was required, i.e. when they print money, they're buying the bonds of the government. So the Federal Reserve are buying the bonds of the government. So it allows the government to borrow more without causing any problems. So right now they're about to start tightening, quantitative tightening. People hear the terminology. And what that basically is a fancy word for we're going to take some money out of the economy. And
they're going to take money out, or they're just not going to put as much in?
Well, if they stop quantitative easing, which is the first step, which they've done, that's not putting any money in, extra money in. When they do quantitative tightening, they take money out. So if there's a big pool of money sitting there and they say, listen, we're going to take 5% of that out every year, that less money around.
So what's the mechanism? So if they want to put money into the system, they buy bonds, amongst other things. They buy assets. But if they want to take money out, what database are they updating? I don't understand.
They sell bonds. They sell the bonds that's on their balance sheet. So they have trillions of dollars of this stuff sitting around where they've stimulated the economy. And then what they do is push it back into the economy. And the idea is it pushes up wages, or all the banks have to buy these bonds now from the government. And so then they buy these bonds and they've got less money left to lend and do other activities with.
The Federal Reserve's actions over the past months have been controversial, to say the least. Some believe that the Fed has affected the stock and crypto market and created a bubble, while Raoul Pal believes that the Fed doesn't really drive this up. He strongly believes the free market does its job. He even recently tweeted on June 15th, the bond and swap markets where everyone pegs their borrow costs to already priced in the tightening required a while ago. Soon they will price in the pause or the easing too. He continued with another tweet saying, the last spike in the rate this week was most likely due to liquidation and not a repricing of inflation fears. If you like my video so far, be sure to give a thumbs up and stay tuned to know more from Raoul Pal regarding the market and economy.
I generally think that the market is better at doing it. If you actually see it, from my perspective, somebody who closely follows interest rate markets and stuff like that, they did all of the tightening anyway, well before the Fed. People you hear the expression, the Fed are behind the curve. What it means is the bond market's already priced it. Like interest rates need to go up to slow down the economy because there's too much inflation, and the Federal Reserve are trying to catch up. I actually think the markets do a pretty decent job in the way that you suggest. Prices rise, eventually it gets too expensive, we stop doing it. Now, there's different equations that people fear is when it becomes super entrenched in the economy and we all go to our bosses and go, I want a pay rise. And everybody does that at the same time. That pushes up prices further. You get more wage rises, and that's a wage price spiral. That really has only happened in the US really once, which was in the late 70s, early 80s, when all of the baby boomers hit kind of 30 years old at the same time. So if you think when you go back to 30, you're kind of settling down with somebody, you're probably thinking about buying a house, you're buying a car, you've got a job, you're starting to earn some money. We had the largest group of people in all history turning 30 at the same time. And they all did the same thing and bought the same stuff. And that really pushed up prices. And that was at the same time, there was issues with oil supply and other things. So we had this double whammy of a demand shock and a supply shock, which meant prices went crazy.
Recently, he also tweeted a number of threads. He started his series of tweets with Marco Update, that is, when the world's most important collateral, U.S. Treasuries, undergo unprecedented volatility, margin calls are everywhere. The world is facing an unprecedented tightening of financial conditions. This is being caused by a variety of factors, including the rise in commodity prices, the increase in interest rates, and the appreciation of the U.S. dollar. This will all lead to a slowdown in global growth and will eventually result in a rise in unemployment. He strongly believes that we are entering into a sharp recession. He pointed out that the SPX is currently pricing ISM at 46.
Debt at economic level happens 4 different places. One is governments. It's called the deficit. You hear this terminology. It's basically how much the government borrows. So you have the US government, you have the US households, individuals, us. You have corporations, and you have the financial system. Those 4 are combined are about 300 and something % of GDP, i.e. GDP is the amount of activity in the economy every year in dollar terms, and they've borrowed an extraordinary amount. This is the most indebted the US has ever been. The financial system's not as bad as it was, so they're not the bad guys this time around. They got told off, they got said, don't borrow as much money. The individuals have not been great, but not terrible. The government borrowed a lot more, and corporations borrowed a lot more. So to put it in perspective, the US is about 25% of the global economy, yet they have 100% equivalent of global GDP in debt. So this is the most indebted economy in the history of world economics.
So Raoul Pal explained how the US is right now the most indebted economy in the history of the world economy. That's a lot of debt. Now, what does that mean for the future of the US economy? Will it create a recession? Now, in another tweet, Raoul Pal has also asked the question if the market will end up in recession like 2008, where the market correction was caused by a housing bubble and a financial crisis, or like in 1974, where the market correction was caused by inflation and stagflation. To conclude my video today, we can all see that this last 2 weeks has really been a week of massive sell-off and liquidations. It's difficult to say for sure what will happen in this economy next. Still, let me know what you guys think in the comments below, and give this video a big thumbs up. I'll see you guys in my next video. So to always stay updated with my latest videos, be sure to hit the bell icon, and also subscribe to my channel. Adios!